In this week's video, we'll review the weight of the evidence and then answer the question, is it bullish or bearish? We'll also address the nagging question, market breadth, is it a big red flag? To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. We're looking at market breadth stats as of the close on Friday, July 17th. Market breadth has been weakening recently. What is market breadth and why do we care? Market breadth speaks to the percentage or number of stocks participating in a market move. That could be up or down. There are numerous ways to measure market breadth. You can do it with percentage of stocks above moving averages. You can do it with new highs, new lows. There are a litany of ways to measure market breadth. Common sense tells us if the S&P 500 makes a new high and 500 stocks within the index make a new high, that's a sign of strength. It tells us that investors are willing to buy a broad brushstroke of securities to push the index to a new high. Conversely, if the S&P 500 made a new 52-week low and all 500 stocks in the index made a new 52-week low, that's telling us that bearish conviction is broad and high. Some concerns. The Nasdaq on Friday made a new closing high, but the percentage of stocks advancing was actually lower than the decliners. 58% of the stocks on the Nasdaq were down when we made a new all-time high, and 124 stocks on the Nasdaq made new lows on Friday, and 151 made new highs. From a volume percentage, 55% of the volume on Friday was associated with declining stocks. That doesn't look very healthy, and it is a legitimate concern. This is new highs minus new lows weekly cumulative for the NYSE, and you can see that breadth here is also rolling over. It's relevant. The question is, how relevant? To answer that question, let's look at this chart, a very common measure of market breadth, new highs minus new lows, from a historical perspective. This is rolling over today, which is very, very similar to this historical period here. We're looking at the exact same breadth indicator on the exact same time frame. Breadth is weakening noticeably here, and it continues to weaken and remains weak for several months. Did things improve? No, things actually got worse. To give you a reference point, this is a cumulative indicator. We're 27,500 here. This is 0 here, and then we drop into negative territory. In this historical example here, market breadth was weakening and or weak for almost 2 full calendar years. To give you an example or reference point relative to 2015, this is a 2-year period of weakness. This indicator made a new high less than 2 months ago. So this is a much, much more extreme example of weakening in a period of extended weakness in market breadth. The logical question is, how relevant was this? Did the stock market crash? Did this peak here tell us it was time to run for the exits, to sprint for the exits? The answer is a confident and definitive no. The moral of the story is market breadth is relevant. It's a yellow flag, but taken in isolation, it is not a reason to sprint for the exits. During this period here where market breadth was noticeably weak and much, much weaker than what we're seeing in 2015, the S&P 500 gained 41%. From this peak here, the S&P moved from roughly 1100 to over 1550 in the spring of 2000. To give us a reference point in 2015, would we be comfortable missing an 872-point move in the S&P 500? 872 points, what are you talking about? An 872-point move is a 41% gain from the close on Friday. Can we afford to be wrong between now and the spring of 2017, which is roughly 2 years from today? If we used market breadth as our sole guide here in 1998, the answers to these questions could have been yes on this time scale. Market breadth is part of the weight of the evidence. It's used in the market model, but it carries a very, very, very low weight. Why? There are much better timing tools. So now let's shift gears and look at the weight of the evidence. This is relevant, weakening breadth in 2015, but how does the big picture look? Before we look at the charts this week, it's helpful to quickly recap the last 2 weeks. We had all of the concerns in Europe 2 weeks ago in the video, kind of the pros and cons. The we should try to be patient list was the long-term trends were still strong. We had extreme and rare bearish sentiment telling us that a sharp rally could be around the corner. Our concern 2 weeks ago, our primary concern, was slowing momentum. Last week, with Greece coming to a head, similar list, reasons to be patient, long-term trends, we were still above support. And European yields were not telling us to run for the exits. However, we still had slowing momentum. Since these two videos, the S&P 500 did react to the extreme and rare bearish sentiment we covered 2 weeks ago. We've rallied 82 points off of the recent low. If this was our concern in the last 2 weeks, how does this look today? Since there's no magical indicator, ratio, or moving average, the market model is widely diversified. There are numerous things that are helpful, but there's no magic bullet in isolation. This is the S&P 500. These are daily moving averages, one of many sets used by the market model. This is what a full-bore bearish period looks like. This is early 2008, the fastest moving average. The blue is on the bottom, and the slopes of all of these daily moving averages are down, telling us that this is a much higher risk and lower probability period than this period here earlier in 2007. These moving averages can help us paint the picture of slowing and recently improving momentum. These are the exact same moving averages on the same time frame a few weeks ago in 2015. This is a confident look. This is slowing momentum, and this is concerning, unquestionably concerning. However, we had the list of reasons to try to be patient to see if momentum could possibly turn around as long as we held above key support. If we fast forward to the present day, we can see that what was slowing momentum and a concern has now turned back up in a bullish manner. So what was a negative drag on the weight of the evidence is starting to become a positive in the weight of the evidence equation. These are a set of weekly moving averages used by the market model. Regular viewers know that a full-bore bearish look is when price is below both moving averages. Blue is below red and the slopes of both are down. A full-bore bullish look and an improving probability look, similar to the one here in 2009, is when price is above both moving averages. Blue is above red and the slopes of both are up. How does the same chart look today? we still have somewhat of a messy look on intermediate term and shorter term time frames. However, this chart looks a lot better today than it did a few weeks ago. We had a lower high and a lower low. Now we've exceeded this level here, and we've moved from a full-bore bearish look to a full-bore bullish look. Also, the support that we noted a few weeks ago has held. We never dropped below these blue lines here. So all things being equal, this chart looks a lot better today than it did a week ago. The market model also uses a wide variety of risk-on versus risk-off ratios. The example here, this is the ratio of the S&P 500, or I'm confident about the future, relative to an aggregate and diversified basket of bonds, or I'm concerned about the future. In 2008 here, when the ratio is falling and we have a full-bore bearish look, it's telling us that the conviction to own defensive-oriented bonds is greater than the conviction to own growth-oriented stocks, and that's why the ratio is falling. Conversely, when sentiment improves and the economy improves, the ratio starts to rise, telling us that the conviction to own growth-oriented, or I'm confident about the future stocks, is greater than the conviction to own defensive-oriented bonds. How does the same ratio look today, and what is it telling us about fear relative to confidence? Similar to 2009 in a full-bore bullish look, the market, or this ratio, has morphed back into a full-bore bullish look as of the close on Friday, July 17th. We have price above both moving averages, blue above red, and the slopes of both are up. What once was resistance for the ratio may now act as support. So all things being equal, this chart, part of the weight of the evidence, supports the bullish case relative to the way that it looks today. We'll keep a flexible and open mind about how it will look in the coming weeks, but it looks a lot better today than it did even a week ago. Looking at the same concept, except this time on a longer-term monthly time frame, we can see .com bust. The ratio is showing observable evidence. I can see bad things happening before really bad things happen in the stock market. Here, we get a lower high in the monthly ratio as stocks make a higher high. This is a bearish divergence. It's a yellow flag, and it was helpful because it occurred in 2007. How does the exact same ratio look today on the exact same monthly time frame? Is it sloping down, or is it moving up? The present day chart looks much, much better. It's got a full-bore bullish look with blue above red and price above both moving averages, and the slopes of both moving averages are up. Is this chart in isolation a reason to do anything? No, but it's a valid part of the weight of the evidence, and it too favors bullish rather than bearish probabilities. This is the ratio of would I rather be long stocks or would I prefer to short stocks. A full-bore bearish look in 2008 and a full-bore bullish look in 2009. The 2015 chart is another example of improvement in the observable evidence. We had a downward sloping and concerning trend channel. We've broken above the downward sloping trend channel. We've gone above this lower high here and exceeded it on a closing basis. And more importantly, the ratio has gone on to make a new high above the weekly closing high that was made in May of this year. We've morphed from a full-bore bearish look to a full-bore bullish look. How about technology stocks? This is what fear looks like in 2002. And this is what confidence looks like after stocks bottomed late in 2002 and early 2003. The weekly chart of the NASDAQ was able to clear this multiple month period of consolidation and make a new closing high. Remember, breadth was weak, but breadth in isolation is not a showstopper. It's relevant, and it tells us to keep an open mind, but in isolation, it's not a showstopper. This chart, like the others, has gone from a concerning look to a much more confident and less concerning look as of the close on Friday, July 17th. There are numerous ways to measure market momentum. You can see here, this is the NASDAQ back in 2012 when Williams percent R weekly, Williams percent R drops out of overbought territory. We can see that after that, the probability of bad things happening increases. We drop out, we can see it. Probability of bad things happening increases. It works the same way when you move into overbought territory. I can see this after it, the probability of good things happening increases. This is the look of momentum. This is concerning. We get a big momentum surge this week, and we're back in overbought territory. As long as we stay there, it tells us that the probability of good things happening is higher today than it was a week ago. Another reason to try to be patient with our longs relates to the fractal and recency bias analysis that we did a few weeks ago. Just updating that. This is resistance for the NYSE in 2007. Here we get our bullish breakout, and we're holding above. So this chart is also saying try to be patient with your long positions, especially as long as we can hold above this line and this line. If we drop into this area here, our concerns would increase. The Dow's been kind of a laggard. How does it look? Notice here in 1987, we get the bearish moving average crossover and a very hesitant look before the major plunge in stocks. And this is an improving look in the Dow in 1998, a period where I might add in 1999 that market breadth was deteriorating and yet stocks continued to rise. As we noted on Twitter and earlier in this video, the intermediate term charts are still a mess. This is a mess. This is consolidation. It's confusion. However, we have seen some improvement even in the Dow. We exceeded this high here this week on a closing basis, and we also broke above this shorter term downward sloping trend channel. This, like many other short and intermediate term charts, still has some work to do, but the probability of bad things happening today is lower than it was even a week ago. Things are improving and things are looking better relative to where they were a week ago, but we don't want to paint a picture of everything as wonderful. It's been a very, very difficult period. The last 14 months for stocks in general, they've really gone nowhere, and they've been going up and down, but making no progress. This is the NYSE Composite Daily. Here's the price on May 1st, 2014, roughly 14 months ago. We hit the exact same level on July 8th of 2015. This is a period of indecisiveness and consolidation, telling us to be patient. This is a more difficult period. Typically, what happens when you move sideways, you either get a breakout to the upside or the downside, and those moves tend to be big. The longer you go sideways, the bigger the move that we typically get to the upside or the downside after a breakout. Using similar concepts here, the market model uses multiple sets of moving averages on multiple time frames. This is the S&P 500 daily here in 2008. You can see we get a bearish moving average crossover. We can see it when the market is still trading at elevated levels. We get another bearish moving average crossover here in July of 2008. And if you remember, between July and November 21st, 2008, it was an ugly period. So these are red flags waving. How does the same chart look in 2015? The answer is much, much better than these high-risk periods in early 2008 and mid-2008. Here, the fastest moving average blue is on the bottom, and the slopes of all of the moving averages are negative. We don't have any of that today. The fastest moving average has shown some slowing momentum characteristics here, but now it's starting to turn back up. And instead of blue being below the other moving averages, the fastest moving average blue is on top, and our slopes are trying to right themselves here. We've got an improving look here instead of a deteriorating look. If we use the exact same concepts, but we use some weekly moving averages with longer durations, we can still see that blue is on the bottom and all of the slopes are down during lower probability periods, and blue is on the top and all of the slopes are up during more favorable periods like this one in 2009. The same moving averages on the same time frame as of the close on Friday, July 17th show us that slowing momentum was concerning here. These are tight moving averages, but now they're turning back up and we have blue on top. This is somewhat of a tight moving average look. When you get very tight moving averages, you can get big moves. So whichever way this resolves itself, up or down, the tighter the look of the moving averages, typically the bigger move that you get in either direction. Right now, this chart is telling us to try to keep an open mind about better than expected outcomes. Why do you keep showing us the same concepts over and over and over again? Because it speaks to the weight of the evidence. When multiple time frames and multiple inputs are pointing in the same direction, it makes us more confident about that probabilistic assessment. These are weekly moving averages here. In 2007, notice we can see a discernible lower high here after this bullish trend line is broken, and then we complete step 3 for a trend change by making a lower low. Notice here blue is on the bottom, which is quite a bit different than here where blue is on the top. This is a transition. How does the exact same chart with the exact same moving averages look today? The answer is much better than this period here or this period here. We have blue on top, and the slopes of all of the moving averages are trying to turn back up in a bullish manner. You can see the slowing momentum and now the improving momentum on this chart as well. Let's talk a little bit about where we are today. This is the S&P 500. This chart is as of July 10th. Remember, weeks ago, way back on May 29th, we said the most important level was 2039. And we also mentioned in the videos that we don't know many things with 100% certainty in the stock market. But we do know this. We cannot go into a 3-week correction, a 3-month correction, a 3-year bear market, or a 30-year bear market until the S&P 500 drops below and closes below the most important level that we identified, 2039. Did we ever do that? No, we did not. We took out these levels, which was concerning, but we never dropped below 2039, even intraday, telling us to try to remain patient. There is no question that down here risks of a waterfall plunge are high. We don't want to minimize that, and that's why we did take a couple of little baby step, small percentage moves away, and why we would have had to reduce risk at a very rapid rate had we taken out this level. Some subtle and small and incremental changes that we saw in the S&P 500 this week. We were able to clear this short-term downward sloping trend channel here, and we were also able to close above this closing high of 21.2420. We closed Friday above that at 21.2664. Nothing particularly earth-shattering about either of those events other than they're baby steps that are telling us that bullish probabilities are improving. Going forward, 2039 was a good level to use as a guidepost. There was nothing particularly magical about it. It was just a guidepost that the market identified here. We have a similar guidepost on the upper end of this trading range. Until we can clear 2134 intraday, and more importantly, we'd like to see a close above that level, we have to have some dose of healthy skepticism. We're still in a range, and the market needs to prove it to us by moving above this level. We also have market breadth to consider, and that is a relevant yellow flag. How do our bullet points look this week? The positives still in place, and now instead of having slowing momentum in the concerns list, we've moved it to the reason to be patient with our long positions because we have improving momentum now. Our concern is breadth, telling us to keep an open mind about all outcomes, including significantly bearish outcomes. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog Short Takes, or watch past videos on the Shavaco Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.